Hey everyone, in this video I'm going to highlight one growth stock down 48.7% that I think you might regret if you miss buying it on this dip here. But before I reveal what this growth stock is, I'm going to highlight some of its financial metrics, discuss why I like the stock so much, and then I'll reveal the stock towards the end of the video. So let's get right into it here, starting with its revenue over a trailing 12-month period. You can see two things highlighted here. Number one, the big thing is the huge dip, the huge crash in revenue in 2020, and that's unsurprising considering this is a travel stock, and travel spending absolutely collapsed during the pandemic. In fact, from 2019 to 2020, travel spending crashed by nearly $1 trillion. That's right, trillion. From 1.5 trillion all the way down to 600 billion, a nearly $1 trillion crash in travel spending. Arguably, no other industry was impacted as hard as travel was. But now that restrictions are easing, people are getting vaccinated, people are feeling less worried about the coronavirus, they're going out, they're traveling again, they're unleashing that pent up demand, and revenue for this company has recovered up to $12 billion in the trailing 12 months, right about the matching the peak where it was in before the outbreak. However, this does not mean that the recovery is complete. Not at all. This 12 billion in revenue is primarily due to price increases instead of quantity rebound. So there's still a catch up left to be done in terms of the amount of travel that's being done, but the total spending is recovering nicely because prices have increased, but the amount of spending, the quantity of travelers has not recovered anywhere near where it was before the outbreak. So there's still several hundred billion of recovery left to complete, and this company stands to benefit from that continued recovery. And already the company's profitability or cash flow has eclipsed where it was before the outbreak. So what I have pulled up here is a chart of its cash flow from operations to sales over a trailing 12-month period, and what you could see, the big crash and rebound, but where it's at right now at 29.84% was higher than where it was before the outbreak. And like I mentioned earlier, primarily due to price increases, so that each individual booking, each individual trip is more profitable than it was before the outbreak because prices are now higher. Okay, so the last thing I will highlight is the valuation. What I have here is the forward price to earnings ratio, and this stock is arguably cheaper than it's ever been, trading at a forward PE of just 9.43. So what you have here is a company that's got an excellent business model that's generating very healthy cash flows. It's got a strong, powerful tailwind behind it as consumers are unleashing this pent up demand for travel, and it's trading at a relatively cheap valuation. For all these reasons, I think you might regret not buying this growth stock here. So, what's the name of the stock? Is Expedia Group, ticker symbol EXPE, one of the most well known, well, I shouldn't say well known, but one of the companies that will benefit tremendously from the recovery in travel, which still has a long way to go. The recovery in travel is not going to end in 2023. I don't think it's going to end in 2024. I think the full recovery will happen sometime in 2025. That's how much devastation happened to the travel industry as a result of the pandemic. So, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.